So what we want to do today is talk about the Fed's monetary policy decisions as it pertains to where the U.S. economy is in the business cycle. So remember, what the Fed's job is to monitor the value of the dollar. At the end of the day, that's what the Fed really is trying to do. They're trying to allow us to go out and use dollars so that we can really easily make economic transactions, which is great for growth. If we don't know what the value of the dollar is, then we can't make transactions with currency, and so we have to resort to bartering, which is going to be terrible for growth. So, the way the Fed is going to operate is dependent upon where we see the economy in the business cycle. So let's talk about a couple of important factors here that might shape the Fed's decision making. First off, when the economy is expanding a little more rapidly than what it normally does, we say that unemployment tends to be low and that there's some inflationary pressure that's starting to tick up. And on the opposite extreme, when the economy is kind of contracting or growing more slowly than what we're used to, unemployment tends to be high and inflation tends to be a little bit low. Right? In these environments, businesses are having to compete for workers. That's going to drive up wages, which means that input prices are going to increase, and some of those will be passed on to consumers in the form of inflation. Then the opposite happens here. There's a surplus of workers. Businesses don't have to compete for them. Wage pressure is held low. That's the exact situation that we're in right now. We listened to the interview with David Wessel on NPR a couple of weeks ago about that. So what the Fed is really interested in, one of the things they're interested in, is the relationship of unemployment relative to the natural rate of unemployment, or the NAIRU. Right? The NAIRU, or the natural rate, is what I'll call it. So the NAIRU is the non-accelerating inflationary rate of unemployment, right? Holy cow. Wouldn't you like to have come up with that acronym? But all that's saying is that this is the unemployment rate where we see inflation constant. That's the unemployment rate where wage pressure is such that inflation is going to increase by an amount that the Federal Reserve is comfortable with, that we can target so that financial agreements can be monitored really well via that Fisher equation. Remember, in order for financial markets to work well, inflation has to be targetable, and the NAIRU is important because that allows for us to think of inflation as being a constant, which is a really easy thing to target. In environments where the economy is expanding rapidly and unemployment's low, the unemployment rate is less than the natural rate, which is going to drive up inflation. And then when the economy is contracting, or it's in kind of a slowdown relative to the average growth rate, usually that means that unemployment's larger than the NAIRU, or it's larger than the natural rate, and that means that there's going to be downward pressure on inflation. Either one of those environments is where the Fed's going to have to intervene with some policy measures to try to either slow down the economy when it's overheating like this, or goose the economy and try to get people to spend a little bit more when unemployment's a little bit larger than what it normally is. So let's talk about how the Fed would do this, and let's talk about it in this environment. If we just talk about it in one environment, then we can just do the opposite in the other environment here. So let's imagine that the Fed is starting to get some data that the economy is expanding a little more rapidly than they like. Maybe unemployment is lower than the natural rate, and the Fed is worried about inflation entering into the system and making it difficult for banks and debtors to calculate the real rate of interest, which is going to slow down capital because of uncertainty, and that's not going to be good for growth. So what's the Fed going to do here? All right, so we are looking at a situation where unemployment's lower than the NAIRU, and there's inflationary pressure mounting. So what the Fed's going to say here is that they want to slow down spending. That's the ultimate drive here with Fed policy. They want to slow down spending. If they can slow down spending, that's going to decrease demand. And we've already seen that when demand decreases, prices start to fall, and that's going to have the effect on inflation that they'd like. They want to get inflation a little bit lower than what it normally is. So by slowing down spending, the Fed's going to accomplish its mission of targeting inflation a little bit better than what it is seeing in this environment. So how's it going to do that? Well, the Fed has a couple of policy moves that it can do this with. The first thing it can do is increase the required reserve ratio. By increasing the required reserve ratio, that means that banks have fewer excess reserves. And it's with those excess reserves that banks go out and make loans or investments that probably will hopefully increase capital and increase economic growth. So if the banks have fewer excess reserves, then they're going to make fewer loans, they're going to make fewer investments. That'll slow down capital. This, as we've said before, is a move that the Fed is unwilling to make because it's such a powerful move in terms of monetary policy. They haven't changed the required reserve ratio in almost 30 years. But this is an option. If the Fed was really, really worried about the direction of the economy, maybe they'd increase the required reserve ratio. So there's one option. The other option that they have, and the one that they meet on 6 times or 8 times a year, sometimes 9. Every 6th Tuesday, the federal, the Board of Governors of the Federal Reserve meet along with the chairwoman and figure out what to do with the federal funds rate. So remember, the federal funds rate is the rate at which banks loan money to each other in order to meet that reserve clause that the Fed makes them meet at the end of the day. So if the Fed wants to slow down spending, they're going to increase the federal funds rate. And what that's going to do is have a domino effect on other interest rates, because what the Fed is doing, as we'll see here in a second, is taking cash out of the economy. That's how they increase that federal funds rate. How do they do this? Well, they sell treasury bills to banks. So in that transaction, a bank is going to buy treasury bills from the Fed, and by buying treasury bills, the bank is giving some of its cash to the Fed, and thereby the Fed has made cash more scarce than what it was previously. So now we've got a situation where the Fed has made cash more scarce. It's going to increase the federal funds rate, which kind of has a domino effect on other interest rates. And now consumers are starting to see a difference in a really important trade-off, right? Because consumers who get an income, they have 2 choices with that. They can either save or they can spend. And when interest rates start to rise, the incentive to save increases. Or I can put this a different way. The incentive to go spend has fallen because consumption in the future has gotten more expensive, or current consumption rather, has gotten more expensive after the Fed has increased that federal funds rate. So what the Fed's trying to do is tinker around with consumers' preferences for saving or spending in the current period, and by making interest rates higher, they've increased the incentive, they've increased the rate of return that consumers are going to get for spending, and if consumers are, for saving, and if consumers are saving, then they're not spending, and that's going to slow down spending. So really what we want to do is we want to see the Fed's decision making as tipping the balance between saving and spending. So by making cash more scarce, by making the federal funds rate larger, the Fed has made current consumption or current spending by businesses and households more expensive. And when they do that in a typical market, we can go back to our supply and demand markets here. Demand is going to fall, which is going to have downward pressure on price, and it's going to have downward pressure on quantity as well. And that's going to mean that some workers are unfortunately going to be laid off during this time period, which is exactly what the Fed wants to do. So to kind of close this out, what we want to see the Fed as, if it's doing its job correctly, is an institution that takes the extremes of expansions and contractions out of the economy. So if this was the world without the Fed, this blue line that I have here, we can imagine a world without the Federal Reserve. What the Fed's trying to do is temper these growth periods so that they're not quite as extreme, which would mean inflationary pressure doesn't mount quite as quickly. That means that unemployment doesn't get as low as it would without the Fed stepping in. And then, on the other hand, downward cycles aren't nearly as bad, so unemployment doesn't get as high, inflationary pressure doesn't get as low, and so we're kind of cooling the heels of the economy when it gets really hot, and we're trying to goose the economy when it gets colder, and the hope of that is for us to be able to target inflation, because if we can target inflation in all of these environments a little bit better than we would otherwise, what the Fed's enabling the economy to do is grow at a little bit higher rate, because debtors and creditors can calculate the real rate of interest because they can calculate inflation better in all time periods.